Hey everyone, and welcome to this explainer. Today, we are diving into a massive financial puzzle that honestly affects almost every single business out there, the IT equipment lifecycle. You know, if you're the one managing technology, keeping your systems current feels like a constant, never-ending battle. But it turns out, the absolute smartest organizations out there, they treat tech as a strategic asset, one that directly impacts cash flow, tax liability, and compliance. So we're going to explore how to look at all those screens sitting in front of us just a little bit differently.
Here is our quick roadmap for today's explainer. We're going to hit the hardware dilemma, figure out if we should buy, lease, or subscribe, decode some lease types, maximize our tax deductions, and finally, nail down that exit strategy.
All right, let's jump right into part one, the hardware dilemma.
So every modern business deals with this exact same pain point. You absolutely need up-to-date technology, right? But buying it outright just completely tanks your cash flow. And on the flip side, holding on to it for too long creates some serious security risks. Which really brings us to a fundamental question you have to ask yourself. Do you actually need to own your tech? Instead of picturing, stacks of laptops gathering dust in a back server room, it actually really helps to think of technology as a continuous flow of capital. It's all about access, not ownership.
Moving on to part two. Let's look at how you actually get this gear. Buy, lease, or subscribe.
Let's start by comparing the two polar extremes here, buying it outright versus device as a service, or DaaS. Buying means you're hit with a heavy upfront capital expenditure. You're basically paying for the whole shebang on day one. Now you do get complete control, but you also take on literally all the maintenance. DaaS, on the other hand, shifts all of that into an operational expense. It acts kind of like a subscription, giving you really flexible, predictable monthly billing. And the managed support is rolled right in.
If we drill down into just purchasing, the pros are pretty clear. Complete control and generally a lower total cost of ownership over time if you manage it well. You also get to control the sustainability side of things by extending its use. But man, the cons are hefty. Aside from that giant initial investment, there is this inevitable depreciation cliff. Right around year 5 to 7, hardware hits its end of life. Suddenly, the risk and the cost of maintenance absolutely skyrockets, and all of that burden falls squarely on the shoulders of your internal IT team.
And honestly, that cliff is exactly why device as a service is gaining so much traction right now. The pros? Super predictable billing, built-in lifecycle management, and it frees up your IT staff to do actual strategic work instead of just fixing broken screens. However, and this is a big however, there is a major catch. DaaS creates a very sticky reliance on your provider. Because you don't actually own any of the hardware, canceling your contract could mean getting hit with massive buyout fees or literally losing all of your company's equipment overnight.
All right, part three. Let's decode some lease types to see if we can find a sweet spot.
So, to find a middle ground between buying and subscribing, a lot of companies turn to leasing. First up is the fair market value, or FMV lease. Just think of this exactly like leasing a car. It's a true operating lease with fixed monthly payments. At the end of the term, you can buy it at whatever the market value is, return it, or just upgrade to the latest model. The incredible benefit here is that the equipment actually stays off your company's balance sheet entirely, and you simply deduct those lease payments as an operating expense. It is absolutely perfect if your strategy relies on continuous upgrades.
Then we have the $1 buyout lease. Now this one functions much more like a traditional loan. You're going to have higher monthly payments, but at the end of the lease term, you secure full ownership by buying the equipment for, you guessed it, exactly $1. Because it is essentially a loan, this asset goes directly onto your balance sheet.
Okay, let's make this super concrete with a classic example, a $10,000 pizza oven. If a business decides to lease that oven on a $1 buyout basis, boom, it immediately shows up as an asset on their balance sheet. Now, why would you want to do this? Well, establishing ownership allows you to potentially deduct the entire $10,000 as a business expense in the very first year. It is a brilliant tax strategy if you know how to use it.
Which brings us right into part four, maximizing those tax deductions.
Just let this number sink in for a second. $2,560,000. That right there is the Section 179 maximum deduction limit for the 2026 tax year, and that was brought into effect by recent legislation known as the One Big Beautiful Bill Act. It represents just a staggering opportunity for businesses to immediately deduct the full purchase price of qualifying equipment. And yes, that even includes off-the-shelf software.
Breaking down those 2026 IRS limits a bit more, you have that huge $2.56 million deduction, but you really need to note the phase-out threshold at $4.09 million. Basically, if you spend more than that threshold, your deduction starts reducing dollar for dollar. So this is very clearly targeted at small to mid-sized businesses. But check out that bonus depreciation line. It's set at an incredible 100% for 2026. And crucially, both of these fantastic tax benefits apply to new and used equipment.
Now, you're probably wondering, okay, what's the actual strategic difference between the two? Well, Section 179 gives you exact precision. You get to pick and choose which specific assets you want to expense. But the catch is, it cannot exceed your taxable income to create a net loss. Bonus depreciation, on the other hand, is an aggressive all-or-nothing deduction for an entire class of assets. And most importantly, it absolutely can exceed your taxable income, effectively creating a net loss. The smartest businesses out there, they expertly blend both of these together for the absolute best financial outcome.
And finally, we hit part 5, the exit strategy.
So when your equipment finally reaches the end of its useful life, the return process honestly turns into a bit of a hidden financial minefield. Let's start with a major accounting hurdle, the ASC 842 trap. This specific rule requires that leases be reported on the balance sheet for your financial statements. But here's the trick. For tax purposes, no asset or liability is actually created. If you mix up these book and tax treatments, which happens all the time, especially in partnerships, you can severely alter your taxable income. It requires some incredibly meticulous reconciliation.
And beyond the accounting side of things, there are just everyday operational gaps. I mean, leasing companies make an absolute fortune off of poorly managed returns. Common traps include, finding out serial numbers don't match while you're packing up the boxes, or just forgetting to include the chargers, which triggers immediate, super frustrating penalty fees. And even worse, losing your certified proof of data destruction, that can literally leave you in violation of strict compliance regulations, like the FTC's safeguards rule.
So how do we avoid all that nightmare scenario? You need a really rigorous workflow. Step 1, pull that lease schedule early. Step 2, physically match every single asset. Step 3, identify any damaged or missing devices early on so you can resolve those exceptions before they become a problem. Step 4, explicitly confirm your data sanitization methods. And Step 5, ensure those final reports live safely with your finance records, not just buried in some forgotten IT folder on a shared drive.
There's this great quote from the experts over at Tech Defenders that I think just perfectly summarizes the ultimate exit strategy. They say, the goal is to make sure the people responsible for security, finance, operations, and compliance can all answer the same basic question. What happened to each asset, who handled it, and what evidence proves the outcome? And honestly, that right there is the absolute gold standard of accountability.
Which really just leaves us with one final provocative question to think about. When the screen goes dark on your equipment for the very last time, where does your capital actually go? Does it just leak out through hidden return fees and lost tax deductions, or is it being strategically rolled right into your next phase of growth? Take these insights, really audit your own lifecycle strategy, and make absolutely sure your technology is serving your bottom line. Thanks so much for joining me on this explainer, and as always, keep learning.